$32 billion. That was FTX's valuation in January 2022, after the smartest investors in the world lined up to fund it. Sequoia Capital was in, Singapore's sovereign fund Temasek was in. The Ontario Teachers' Pension Plan, managing the retirements of Canadian school teachers, was in. 10 months later, all of it was gone. Not slowly, the way most companies die, but in 9 days, between a leaked spreadsheet on November 2nd, 2022, and a bankruptcy filing on November 11th. $8 billion of customer money was missing, and the man hired to clean up the wreckage, the same man who cleaned up Enron, told Congress he had never seen anything like it. Today on Collapse, the Vanishing Act, exactly as the courts reconstructed it, and the one design flaw that guaranteed the ending from day one. First, the story everyone bought. Sam Bankman-Fried was a physics graduate from MIT with unbrushed hair, cargo shorts, and a pitch that disarmed every skeptic. He was only getting rich to give it all away. The press called it effective altruism, and it worked like a character reference. He testified before Congress and shared stages with Bill Clinton and Tony Blair. Sequoia published a glowing profile noting he played League of Legends during their pitch meeting and wrote him checks anyway. $214 million in total. Tom Brady and Steph Curry took equity to appear in ads. The Miami Heat's arena became FTX Arena in a $135 million deal. Larry David starred in a Super Bowl commercial where he doubted FTX, and the joke was on the doubters. The joke, it turned out, was the ad. Here is the structural flaw everything else grew from. Bankman-Fried owned 2 businesses at once. FTX was the casino, an exchange where 9 million customers deposited money to trade crypto. Alameda Research was a gambler, a private trading firm betting billions in those same markets. And he owned about 90% of it. An exchange is supposed to be neutral ground. It holds your deposits, matches your trades, and takes a fee. Having the exchange's owner also run the biggest trader on that exchange is like a poker room where the house also sits at the table, sees the cards, and can reach into the cage. Traditional finance separates these functions by law. Crypto had no such law, and FTX ran offshore from the Bahamas. Every investor could see this structure. Almost nobody priced it. The jury did not have to speculate about what connected the 2 companies, because FTX's co-founder walked them through the source code. Gary Wang, who wrote it, testified that Alameda's account on FTX had secret privileges hard-coded into the exchange. A setting called Allow Negative let Alameda's balance drop below 0, meaning it could spend money it did not have, which on an exchange means spending the other customer's money. Every normal trader faced automatic liquidation the moment their losses exceeded their collateral. Alameda was exempt, and its line of credit was set to $65 billion, a number so large it functioned as infinity. No other account had anything like it. It was written into the platform in 2019, the year FTX launched. The Vanishing Act was not improvised in a panic. It shipped in version 1. The second trick was the collateral. FTX printed its own token, FTT, and Alameda's balance sheet leaned on it. When the crypto market boomed, FTT's price made Alameda look rich, and it borrowed billions from lenders against those holdings. But think about what FTT actually was. A token FTX created from nothing, whose price FTX's own ecosystem propped up, held in bulk by the founder's own trading firm. Alameda's wealth was a claim on FTX, which was a claim on Alameda. The court heard that when crypto crashed in spring 2022 and Alameda's lenders demanded their money back, the firm repaid them with billions taken from FTX customer deposits on Bankman-Fried's direction. Caroline Ellison, Alameda's CEO, testified that she prepared 7 alternative balance sheets to hide it. The circle held as long as nobody looked inside. So where did $8 billion of customer money actually go? The trial and bankruptcy record drew the map. Around $300 million bought Bahamas real estate, including a $30 million penthouse where the inner circle lived and properties for Bankman-Fried's parents. Hundreds of millions went to celebrity endorsements and naming rights. Tens of millions flowed into American politics, to both parties, some of it through straw donors, making Bankman-Fried one of the largest political donors in the country. And billions went into venture bets, including $500 million into the AI lab Anthropic. None of this was house money. The house had no money. It was 9 million depositors' money, moving through an account that could not go bankrupt because the code said so. Now the collapse, day by day. November 2nd, 2022, the crypto outlet CoinDesk publishes a leaked Alameda balance sheet showing $14.6 billion in assets, of which $5.8 billion is FTT. The token FTX prints itself. Readers do the math. The empire's foundation is its own IOU. November 6th, Changpeng Zhao, head of rival exchange Binance and an early FTX investor, tweets that Binance will dump its roughly $500 million of FTT. That tweet functions as a fire alarm. Customers rush the exits, pulling about $5 billion in a single day. A real custodian survives a bank run because the deposits are supposed to be sitting there. FTX lasted about 72 hours. November 8th, withdrawals freeze. Binance announces a rescue takeover, looks at the books, and walks away in one day. November 11th, FTX files for bankruptcy in Delaware. Enter John J. Ray III, the restructuring lawyer who administered Enron's corpse, appointed CEO on the day of the filing. His first-day declaration is one of the most brutal documents in bankruptcy history. Quote, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information. This was a $32 billion company that used QuickBooks, the accounting software for corner shops. Expenses were approved with emojis in Slack. Communications ran through auto-deleting signal threads. There was no complete list of the company's own employees, no accurate register of its bank accounts, and no board worth the name. Corporate money bought homes in the personal names of staff. Enron at least had auditors to fool. FTX skipped the pretense." The trial, in October 2023, was short on mystery because the witnesses built the machine. Gary Wang, the co-founder who coded the Backdoor, pleaded guilty and testified. Nishad Singh, the engineering chief, pleaded guilty and testified. Caroline Ellison, Alameda's CEO and Bankman-Fried's on-and-off girlfriend, pleaded guilty and delivered the sentence that framed the whole case. Alameda took around $14 billion from FTX customers and, quote, "Sam directed me to commit these crimes." Bankman-Fried took the stand in his own defense and told the jury he made mistakes, but committed no fraud. The jury deliberated for about 4 hours. Guilty on all 7 counts, including wire fraud and money laundering conspiracy. In March 2024, he was sentenced to 25 years in federal prison and an $11 billion forfeiture. Then came the twist nobody predicted at the bankruptcy hearing. The money came back. Mostly. The estate's fire sale assets rose in value, and the star was that $500 million Anthropic stake, which sold for about $1.3 billion as the AI boom repriced everything. In 2025, the estate began repaying 98% of creditors around 119 cents on the dollar. Bankman-Fried's defenders now say nobody lost anything. Here is why the customers disagree. Claims were valued in dollars on the day of the bankruptcy, when Bitcoin traded around $16,000. By the time checks arrived, it traded several times higher. Customers got back the dollar value of the bottom of the market years late. That is repayment, not restitution. The judge said as much at sentencing. The money was taken, gambled, and lucky. Step back and the FTX pattern matches every episode in this series. Like Enron, the reported wealth was a claim the company wrote on itself. Like WeWork, a founder's story substituted for governance, and the investors who should have demanded a board seat took the growth instead. Sequoia lost $214 million. Temasek lost $275 million and publicly apologized. Ontario's teachers lost $95 million of pension money. None of them ever saw properly audited financials because none existed. The uncomfortable lesson is that due diligence is a market too. In a boom, the price of asking hard questions is losing the deal to someone who will not ask. Every investor knew one man owned both the casino and the biggest gambler in it. The structure was the disclosure. The backdoor just automated it. Let's land this. FTX did not collapse because crypto prices fell. It collapsed because customer money and house money were never separate, and the code was written that way from the beginning. The test it teaches costs nothing to apply. Where does the money sit, who else can touch it, and what happens if everyone asks for it back on the same Tuesday? A real custodian has boring answers to all three. FTX had a $65 billion line of credit for the owner's other company. When someone brilliant is only getting rich to give it away, check who is holding the wallet. This is education, not financial advice, so do your own research. Tomorrow on The Current, Nvidia's earnings landed last night, with 7.8% of the S&P 500 riding on the print, and we count what the AI Trades Week of Doubt actually did. Subscribe so you don't miss it.